Well, welcome everyone to Finke's Grow Your Property Investments and Work Because You Want to. This is session 2 and my name is Tiffy Rubinat. On screen we can see Emma and Lizzie. They're both muted right now, but they're gonna be participating of session number 2. So I'm gonna just jump straight into what we're gonna be covering today, and it's gonna be 4 topics. The first one is about mortgages or loans and how they work and the different types that you might get. Then we're gonna look at a rule called Rule of 72. And I think that's a really cool one. Then we're gonna be talking about strategy for any types of investments, and within the property world, we wanna talk strategies that involve both capital growth and cash flow. And then we are gonna be doing one exercise about how we start our area research, okay? So those are the 4 topics we're gonna be covering today. So I'm gonna start by mortgages. Guys, I know you're both muted, but let me know if you have any questions at any point in time. You can interrupt me, okay? Cool. So let's start with mortgages. So the 2 typical types of loans that you get when we're talking about property investments are one called principal and interest, and the other one called interest only, okay? So when you look at the graphs, the one at the top, it's the principal and interest one, whereas the one at the bottom is the interest only. So I'm gonna start talking a little bit about what you can see as differences. So in the principal and interest one, I'm gonna start by saying that over the life of the loan, you most likely will be paying the exact same amount of dollars to, let's say, the bank. The bank is loaning you money every single month or year or whatever period you have as an agreement to pay back. But what you're paying of the principal, so principal is the amount that you asked a loan for, it's gonna be actually at the beginning very little, and you're paying mostly interest. So everything in red in the screen is the principal, and everything in green is the interest. So as an example, let's say that I ask for $100,000. That is my principal. But if I'm doing this over a 30-year period, most likely when the 30 years end, I would have given back to the bank almost double that amount, as in half of it would have been the 100K of the principal and an extra approximately 100K of interest over the 30 years, okay? Now, every year we pay the same amount to the bank, but it's different parts of the principal. And the reason why at the beginning the interest is higher is because interest is calculated on the principal that we owe. So as you start paying off the principal, then you owe less money and your interest payments go down, okay? Now, when we look at the interest only one at the bottom, what you see is that over the life of the loan, every month or year or whatever it is that we're doing the repayments, you only pay interest, and it's a constant interest because you never pay the principal, then you always owe in interest the same amount. And then for the last period, you actually go and pay the interest plus the entire principal, okay? So these are the 2 types of mortgages that you get. I'm gonna go to the next screen where I'm gonna show that there's actually a 3rd option. It's not that common when it comes to property investments, which is one where you are constantly paying the same amount of principal and your interest starts going down. That is not normal, to be honest, but I'm showing it in case that at some point you are presented with that option as well, okay? So let's jump a little bit more into principal and interest. So on the left-hand side of the screen, you have a graph that shows that you've asked for a loan, and the loan is for $100,000 over a 30-year period, okay? So what you're seeing there is that every year you're gonna be doing the same annual payment. So the annual payment is on the bottom, sort of bluish type of bars. Now, as you start paying off the debt that you have, you start earning equity. So I'm going to describe what equity means. Equity is the difference between the value of the property and what's left of the mortgage to pay. Because for those 30 years that you're owing money to someone, let's say it's the bank, the property is not fully yours, okay? The property will only be 100% yours after you've paid the entire debt that you have with the bank. So equity is something that you can access because you are owner of your house. And especially in this particular scenario, we're not assuming, but let's say that properties do raise in value over time. As properties raise in value and your debt, you start paying off your debt and your debt was in an older, lower value, then your equity starts growing because the actual value of the house versus what you are owing, there's a big difference. And sometimes banks are happy to lend you the difference in money and release that equity. Does that make sense? Do you have any questions about equity? No. Cool. So on the right-hand side, you have an example for what an offset account is. So when you ask for a loan, you're going to be opening a bank account where you're going to be putting the, let's say, monthly payments or annual payments, whatever it is. Now, some loans that are in the principal and interest type of loans, you have access to having an offset account. Now, an offset account is an account that you can put and take out money if you wish to. So how you would use it is, let's say that you ask for a loan and your monthly repayments should be $1,000, but actually you have more of that in savings that you wish to allocate to paying off the principal faster. So instead of paying it over 30 years, you want to pay it as soon as possible, okay? So in this offset account, you can put all of the money that you could have had in your own savings account. And this offset account is great because the interest is calculated on the principal that you're owing. So if you're putting money into that offset account, that entire money or sum of money will be paying off the principal part. So then your interest repayments start going down, okay? So in this example here, what you see is you have in savings 15,000 pounds in this case of this example that you're putting into this offset facility or offset account, and you had asked for a loan of 150 pounds, but basically you just like this paid 15,000 pounds. So the interest is calculated upon the 135K remaining of the principal that you're owing, okay? Any questions? No, cool. So I'm going to now jump into interest only and talk about a few, 3 examples. These actual pictures come from the Australian government's page. So they try to explain the difference between an interest only and a principal and interest. So I'm going to start by the right-hand side, which is the journey of interest-only loan borrowers and versus a principal and interest. So you'll have 3 people in this example, okay? You'll have Linyi and Bruce on the left, Amanda and Raj in the middle, and David and Louise on the right, okay? So I'm gonna, all 3 couples will be borrowing $750,000 over a 30-year period. Now, the couple in the left, Linyi and Bruce, they're gonna be asking for a principal and interest loan, whereas the other 2 couples will be asking for an interest-only loan. Now, the interest-only period cannot last in general between more than 5 years. So usually when you ask a bank for an interest-only loan, it's either between 2 and 5 years, okay? So in this example, what we're comparing is that the interest-only period is for 5 years, okay? And after the 5 years, the remaining 25 of that loan, you will have to start paying principal plus interest, okay? So I'm gonna use the pointer, give me 1 second. I'm just gonna bring it to screen because it's easier for you guys to follow me. Okay, so let's start with Linyi and Bruce here, okay? Now, they have asked for a principal and interest loan, and the interest rate is 3.95% per annum, okay? Now, the monthly repayments, because they've asked for a principal and interest over a 30-year period, it won't affect, so they're gonna be paying the same the first 5 years versus the remaining 25, and that's every month they're gonna be paying back $3,559, okay? So even if they're paying they're borrowing $750K over 30 years, by the end of the loan, they would have paid the bank 1.281K, okay, million actually. So 1,281,000. Now, when we go to example number 2, which is Amanda and Raj, this example is here only for education purpose only. It's not realistic, and the reason for that is because it says that the interest rate they're getting is 3.95. I'm going to say that realistically, if you're going to go and ask for an interest-only loan, most likely you won't be able to get the same interest rate, and it's always going to be slightly higher. So interest-only rates are higher than principal and interest, and that's why the scenario on the right makes more sense, okay? So we have Amanda and Raj, and they will be paying the interest only for the first 5 years. So the monthly repayments during this period are of $2,469. So if you can see the difference, there's almost $1,100 difference the first 5 years each month that they're paying less. And that's because they're only paying the interest part and they're not paying part of the principal. Now, after that 5-year period is over, they do have to start paying principal and interest. And that's when their payment goes up. So you can see that instead of paying $3,559, they're paying $3,938. So the great thing is that over the first 5 years, they were able to save around $1,000. And now for the remaining 25, they will have to pay approximately $400 more per month. So here what you can see is that by the end of the 30-year loan, they've paid almost slightly below 50K more back in interest because they decided to do interest only. And that's assuming that they got the same interest rate. Now, in a more realistic scenario where we have David and Luis, they have been given an interest rate of 4.25 for an interest-only loan. And that means that the first 5 years of that interest-only period, they're paying $2,656, so almost $900 less than the principal and interest. And then after that 5-year period is over, they're paying back every month $4,063, which is more or less, let's say 400 more. Sorry, this was 400, this is 500 more, okay? So as you can see, that difference in $500 of repayment over a 25-year period ends up being almost $100,000 difference over the 30-year period, okay? So there's benefits to doing interest only versus principal and interest. So the benefits that I see is I would only recommend interest only if you're doing this as an investment and not your own home. And the difference that you are not paying back over the first 5 years, you're actually using it to reinvest it, okay? So you have money creating more money, which in the long term will pay for this difference. So I do not recommend some people, and I've heard of some friends of mine who have bought their own home and they couldn't afford their repayments during the first years by doing a principal and interest. So they went into an interest only just to be able to afford a more expensive home. And to me, that's just a very, very tricky situation you're getting into. And it's not money generating more money, you're significantly increasing your expenses. So basically, I wouldn't recommend that. So let's talk about benefits and pitfalls for the interest only. So the pitfalls are that you have a higher repayment when interest only period ends, so the remaining 25 years in this case. You have more, it's more expensive over the life of the loan. The principal, of course, won't be reduced over that 5-year period that you're paying back the bank. And the interest rate may be higher than a principal and interest loan. And that's actually reality, right? That's why we said the middle example wasn't actually very realistic. Now, as to the benefits, you have lower repayments at the start of the loan, which is great, greater tax deductions for investment properties, and you can be used for a bridging or construction loan or whatever you want it to be to keep reinvesting it. So I do see a benefit in interest only if I'm going to be using that money to keep investing. Otherwise, I would stay clear from it. Okay, so going to any questions, guys? Okay, Emma, I'm going to assume that if you're still muted, you don't have any questions.
No, I don't have questions.
Cool. So that was the explanation about loans and mortgages. And now I'm going to jump into the rule of 72, where you can see how what I just explained about offset accounts will come into play here. Okay, so the rule of 72 is a really cool rule that if you have any further questions, you can go and Google it. There's tons of information over the internet. But basically, it will allow you to understand how long it will take for investment to double. Okay, so it's a very basic formula. And if you guys have a phone with you, I invite you to pick it up and grab your calculator, because you can actually do some like quick maths to prove it yourself. Okay, so the rule of 72 says that if you take the number 72 and divide it over a return on investment, the resulting number is the number of years it will take for your time to for your investment to double in time. Okay, so I'm going to make an example, but let's say with example number 1, we have money on a savings account in the bank. Okay, and the best I've been able to find over the last couple of years in interest given by a savings account was 2.8. But basically, this 2.8 that I was receiving, I received over a 2-year period. 3 months ago, the banks have started lowering their interest rates for the savings account. And now the highest interest rate I'm able to get in this market is 2.3. Okay, but I'm going to still keep this very optimistic 2.8 interest given by a savings account. And the example is, let's say you put $50,000 in year 0 into this savings account and you keep it there, and that money every month, let's say, will be generating an interest that will be paid into your account, and that keeps itself reinvesting over a certain period. So if I take the calculator and I do 72 divided 2.8, that is 25.7. And that's why I put that more or less in year 26, your 50K would have become 100K, okay? Now, when in the following example, it says house, what I mean is, let's say that you had a house with a home loan or a mortgage and an offset account, and the interest you're being charged in your for this home loan is around 5%, okay, which is a pretty high interest. So, of course, what I'm trying to explain here is I see a benefit of putting your money into your offset account versus having it in a savings account in the bank, because you will be better off. But then I'm gonna show you 2 examples of different types of investments that give you an even better return than having your money on that offset account, okay? So going back to the example of the house, assuming there's a 5% interest rate in that loan that you have, you could be putting 50K in year 0 towards paying off your home loan, and basically the 50K would, let's say, would have doubled in value over a 14-year period, more or less, and then by year 29 you would have 200K. Okay, now what I'm trying to say here is you won't actually be given that money by an offset account. But what I'm trying to use this for is to explain how, yes, don't put your money on a savings account. I recommend you put it into an offset account, but actually there's better ways to invest it, okay? So already way better than a typical bank savings account. Now, the third option here is called mutual funds. And mutual funds would be when you go and want to invest in shares and you don't want to bother with looking up the companies yourself. And what you're doing is you're investing in a company that, of course, is part of the shares market. And that company takes the money of all of the people who invest in them and invest it in across different stock markets around the world in different types of industries, diversifying the risk. So usually mutual funds will see over long periods of time an average return of 6% more or less. It doesn't work, these averages don't work in the short term, it's over long periods of time, but let's stick more or less to a 6% return on your money from a mutual fund. So what that means is that in year 0, you are putting 50K towards this mutual fund, and those 50K would have become $100,000 by year 12, $200,000 by year 24, and $400,000 by year 36. So you can already see how mutual funds are better than having money put into either a savings account in the bank or towards your offset account in your home loan, okay? Now, when we go into property investment, I'm going to be teaching you guys over the next couple of sessions that we will be asking our property investments to give us a return on investment of 8% or above. So when, let's say we take an 8% return on our money, then if we're putting $50,000 in year 0, by year 9, we would have had 100K, by year 18, 200K, and by year 27, 400K. So you can see how putting money into a property investment makes you be 4 times better by year 27 versus the bank's savings account, okay? So this is the rule of 72, and you can always use this rule to compare how long something, like some investment, it will take to double in value. Now, something very important to know and to have in our heads, and a very easy one is, if we do 72 divided 7.2, that's 10, right? And that would mean that for a 7.2% return on investment, your money would double in 10 years. So you know that if you're investing in anything that has a return on investment higher than 7.2, you would expect your money to double in less than 10 years, okay? Any questions?
No, everything is perfect.
Awesome. So I'm going to go into the next slide, and we're going to be starting to talk about strategy of any property investment, okay? So the first thing that we want is to, now in the next slide, we're going to be talking about different types of strategies, and we sort of need to have clarity on what strategy fits us best. And we're all very unique, and what fits me might not fit others. So it's very important to know what individually we want, okay? So once we define a strategy, we will start our area research. Then we will analyze deals, and after analyzing the deals, we're gonna come back and check that it works for our strategy. Because what could happen is that a deal is great for a flip, but not for rental income, or vice versa. It's great for rental income, but as a flip, which is like buying, renovating, and selling, doesn't work very well, okay? So basically, point 4, it's about making sure that when we run our numbers, that the analysis of our deal is great to fit our own strategy. Then we will be focusing on raising funds, and I know that a lot of people, including myself, would have been the most concerned, as in the first thing that you want to sort out is how you raise funds. But usually, and it's very hard to understand when you haven't done it, but I've now proven it myself. When you have a great deal and you start offering to people, if it's a great deal, people will say yes, and you can raise the funds. So I know it's very hard not to focus on raising the money first, but actually without having some concrete deal that you can put on the table and say, hey, this is real and this is what it will get you, it's very hard to raise money, okay? And then finally, you will execute the deal with the aid of your power team, which we discussed in session 1. So here we have Benjamin Franklin saying, if you fail to plan, you plan to fail. So basically, planning is a key part here. So let's talk about strategy. And sorry, I'm going to have some water because I'm coughing a lot. 1 second. Okay, so we want to have a portfolio strategy, and we want to make sure that in the different cycles of a market, we are doing what will be most profitable for our portfolio. So basically, when I talk about portfolio strategy, you have 2 types of income. You have income from rental income, and then you have capital growth, okay? So when you look at the bottom left, you have that pyramid. You can see that on the left side, it says return on investment, and you would expect your return on investment. We said we were asking a minimum of 8% and above, right? So you can even go higher than 8%. So the moment that you start going up the pyramid, your return on investment will go up. It could go to 100% return on your investment, but of course the risk will also go up, okay? So the higher the return, most likely the higher the risk. And you want to make sure that before you go to that top of the pyramid, you are setting the correct foundations so that if anything goes wrong, and things can go wrong, you have a self-sustaining and self-generating portfolio that you can keep like covering for anything that doesn't go well, okay? Now, this type of pyramid is based on the Fibonacci series. I'm not going to explain what the Fibonacci series are, but for people who love maths and are interested in checking that out, more than welcome to Google it and start analyzing a little bit more. But that's where the numbers on the right of this pyramid are based on the Fibonacci series and are more or less the range of number of properties to have a really strong, self-sustaining, self-generating portfolio that for sure, if you have that type of portfolio, you would be financially independent by then, okay? So I'm going to start explaining from the bottom to the top. So basically, I'm going to use the pointer. Let me, 1 second. Okay, so we start at the bottom with the basic, cheap and cheerful buy-to-let income. So BTL stands for buy-to-let, and it's a synonym of buy and hold. So buy-to-let is something used as the wording used in the UK mostly. Buy and hold is used more in Australia, and you can hear it in many other countries as different things, okay? But basically, you're buying something to keep it for rental income. Now, it says basic, cheap and cheerful. And you can see an arrow coming from this one up here, which says basic cosmetic first appreciation. So what we're hoping to do is buy something that needs a little bit of work, a tiny bit. It could be paint or carpets or something. And what we're trying to do is immediately force that appreciation the moment that we buy the property. And then we will probably ask for a remortgage. So basically, we're going to get our house valued, and the new value will be higher no matter whether the market is going up or down, because we just forced appreciation. And basically, once we get the new loan, we pay the old loan back, and with that difference in money, we can keep investing on the next basic, cheap and cheerful buy-to-let, okay? So they work hand in hand, and this one funds the next basic, cheap and cheerful buy and hold for income. Now, up here, so basically the bottom line is for income, this one is for capital, this one is for income, this one is for capital, okay? So you can see that always you have like a layer of one and the other. Now here what you have is shares and HMOs. HMO stands for house of multiple occupancy, and that is when you have more than one rental contract, okay? So you need to have 2 or more. Now, when you have more than three and above rental contracts, that becomes an HMO. So HMOs are sharers, but you could have sharers that are like 2 bedrooms, let's say, they're smaller, okay? And the sharers and HMOs will probably, tenants will be sharing, let's say, kitchen, common areas, toilets, and stuff like that. So it's not, let's say, 2 houses in one title, because 2 houses in one title, the tenants, yes, you have 2 different contracts, but they don't share anything really. So these ones, of course, will cost more money than the basic cheap and cheerful buy-to-lets, but of course will give you a higher cash flow, right? And how you can fund these ones is probably when you start doing flips. And in flips, you're hoping probably to do a little bit of a bigger renovation than the basic cosmetic one. So maybe you start moving some walls, adding some spaces, adding an extra bathroom, doing an extension. It's something slightly bigger so that you can release more money when you sell it, okay? And that will fund your shares and HMOs. And finally, as number 1 here, you have your bigger developments. This could be like apartment units, hotels, or like something truly big. And probably you wouldn't want to manage more than one of these at a time, because they do bring a lot of complexity and a lot of things that will go wrong simultaneously. So you want to be solely focusing on one thing, okay? Of course, when you're doing a development, you could get 100% return on your money, but you are going through, you need a lot more money to get started, and the risk is significantly higher as well, okay? So this is basically the combination that you would want to have of the different types of assets to have a truly outstanding portfolio. Now, I've shown previously in other videos this graph, but this graph would represent what happens in any market, and not even just property. It could be in the stock market or any market. So in the long term, we see a growing trend, and that's that blue dotted line. But within the shorter periods, you see fluctuations and the market going above and below that average value, let's say. So what you want to make sure is that if you're trying to do flips, then you are way better doing them on this part of the curve whilst you're seeing growth versus doing it in recession. Because if it's a huge recession, you might be forcing a lot of appreciation, but because the market value is going significantly down, you might not deliver it, sell it above the price that you bought it and the money and time you've spent renovating it. So make sure that flips happen mostly on this side of the curve. Now, if you're renting out for income, whether it's the basic cheap and cheerful buy and holds or the shares and HMOs, then those will work both when the market is rising and when the market is declining. And to be honest, probably whilst the market is declining, more people are going to be needing places to rent. And because it's demand and supply, it might happen that your rents go up, okay? So definitely when you're going for income, it works in both parts of the market. But if you're in a recession period, then don't do flips. Then just do them on this part of the curve. And my recommendation is income before capital if you can. Now, this is because your income will start generating more money that you can keep reinvesting for other things. However, I've met people who are starting with money that isn't theirs, and they're finding ways, creative ways to make this happen. And because they are in a rising market and they want to keep cycling money so that then they can start doing it with their own money as well. And they start with flips, okay? Now, my recommendation is income before capital because of our risk situation, if you can do so. But of course, so many people have made it work in so many different ways. So that's the part about portfolio strategy, and defining what our strategy will be before we do our calculations. It's going to be key. So basically, when I said if we're interested in doing analysis for an area, if we're only considering flips, then probably you're needing to go for areas that are seeing great growth. Otherwise, don't even bother, okay? Whereas if you're seeing, if you're wanting to go for income, you will see how we will also focus on areas of growth. But there's people who might be happy to be doing it in areas that are currently on the very low part, because there's really good opportunities to purchase properties at really low prices, and there's still great potential because it's going to be for income. So I'm going to now jump into the income strategy just for a tiny bit. 1 second, I'm going to have some water.
TP, can I ask a question?
For sure.
Do you hear me well? Sorry.
Yes.
Okay, perfect. So I guess my question about the portfolio is ever since you mentioned it, I'm very curious as to, so you have a strategy to build up your own portfolio. Is this, I understand the table, like the pyramid that you just explained, but my question is, because I'm a designer and I have a use for portfolios and I use it to show my clients, is it the same with houses? Is it the same with property investments? You have your portfolio and does it validate you with possible investors, or it's like something that it's only for you to have a reference?
You know what? It can serve as validation. So when I started with my first property, I was forced to go and look for investors, and I had nothing to show for myself. But I put a really strong case together and I presented it to the first set of investors, and they were happy to proceed because it was a really good deal, okay? They trusted me, they knew me from before, and I had nothing to show for. Now that I've done 2 properties, and the second property had 2 houses on it, so it's 3 houses that I fully renovated and rented out, and I have very strong business cases where I over-delivered on every single one of them. If I need to keep looking for investors, of course, now I'm attracting more people wanting to lend me money, and it's not for banks, right? Like actually, I'm not, a bank doesn't want me because I don't have a stable income, but from investors who understand what I'm doing, and now I have more and more to show for myself. I'm getting more opportunities, and I have had people come and tell me, Tiff, the next time you do something, I want to invest. So if you're trying to raise money, just like I am, definitely a portfolio will help you and showing actual results. But you can start without having any experience, just like I did, because you're going to be learning so much and how to put a really strong case together that after you validated everything, you're showing investors before getting into a deal what, like, you can guarantee certain things, and you are not going to be you always, in my strategies, under promise and over deliver, because you want investors to keep coming back to you and offering more money. So I've always played low balls for the rental income expected. I always overestimated how expensive a renovation would be, because I know that things go wrong all the time. So you want to make, of course, you want to make things that work, and you always can find excuses to not make something work. But as long as you're being realistic about the numbers that you're looking up front and presenting it, the first one is always going to be, whether you're investing with your own money or someone else's money, the first one will always be the hardest one, because you have no experience and you're the most afraid. Once you've done it once, you're like, oh, cool, now I know I can do it. But yeah, portfolio can help you in the long run, but it doesn't stop you from starting.
Okay. I'm happy that we're going to learn how to build up a portfolio.
Cool. So in my ideal, so when Max and I started, we wanted to do the first one with our own money, so that then we could prove that we could do something ourselves and start then raising money. And in the end, because of a law situation where the law changed just when we were about to buy one, and we weren't citizens and we needed someone who was a citizen, we were forced to look for investors. And our mindset was always, when these sorts of negative things happen and that changing law was like, no, what are we going to do right now? It ended up being for the better, because it forced us out of our comfort zone. And in the end, we realized we could go way faster through investors, and we managed to do it. So you'll find the ways around it. Okay?
Perfect. Thank you.
So now going into this strategy only for income. So at the bottom, you have your typical houses that are buy to let, where you would expect more or less to get, let's say, $400 in cash flow every month. And I'm talking Australian dollars, and it depends each market, of course, or sorry, New Zealand dollars, Australian dollars, but depending, we will start talking how the minimum that you want to get in cash flow for a $200,000 property is $400 in cash flow. Now, if, of course, the property goes up in value, you will want, it's sort of a linear relationship, you will want more cash flow. And if it's lower, you are able to get started with, let's say, $100,000 property, then you would be happy with that $200 cash flow as a minimum, right? You can ask for more, but the minimum that you want to get is that in cash flow. After the buy-to-lets, you have the social housing, and that's what actually I'm doing with my first property. So I'm renting it out to the government, to the New Zealand government for social housing, and I'm getting it's a bigger house. It has 5 bedrooms and 2 bathrooms, and I believe it's great because who is more reliable than the government to take care of a house, and they will be paying if something goes wrong with the house, right? Then you have your multis, and then you have your HMOs. Okay, so this is more or less how the pyramid of the income strategy comes to life. So I'm now going to start talking about how we assess a certain market, and this could apply to a country, a city, a suburb, but it's just the general assessment of a market, okay? And we're going to be using a mnemonic called ARIDE. ARIDE stands for actual evidence, ratio of affordability, interest rates, demand, employment, and economy. So I'm going to start with actual evidence. So we will be checking house price trends. Of course, we will be checking the rule of 72 to understand how long it's taking for houses to double in price. And depending whether it's income or capital growth that we're actually going, we will want to check the different types of things that we're expecting, right? So even if it's income, you are hoping for evidence that the market is in growth. You will be checking for number and types of mortgages and the speed and strength of sale. So let's say UK is a country where they actually lend money to foreign investors. And that's amazing because they don't lend based on your job, as in they could never prove wherever you're sitting in the world whether your income is your actual income. But if you present a property to the banks that has a strong business case behind it, then they will be willing to lend you money, okay? Now, when we talk about the US, for instance, the US won't lend money to foreign investors. They do welcome foreign investors, but they don't lend money to them, okay? So it depends on where you're starting and what's happening. So I'm investing in New Zealand, and New Zealand and Australia governments like talk to each other, and they can validate information about your income and salary and stuff. So as an Australian citizen, I can go and ask for a loan in New Zealand, okay? Then we have the ratio of affordability. So I'm gonna put a very basic example here. So ratio of affordability will tell you whether a market is really unaffordable or not. And I'm gonna use Australia as the example of a very unaffordable market. So let's say that the average house prices in Australia right now, and this is lowballing it, it's around $800,000, okay? That's the average more or less. And the average salary in Australia, it's 80K, okay? So the R there would be approximately a 10, right? 10 is an extremely unaffordable market. What you're looking as an average affordability is a ratio of 5, and where the ratios are below 4, it's most likely the prices are going to be going up because people who are not being able to afford the unaffordable markets will be moving into those more affordable. And that's what we, for instance, in Australia, the market has seen a massive boom over the last 10 years, and the last year and a half it's been in decline, and mostly driven by Sydney and Melbourne. And Sydney and Melbourne are extremely unaffordable markets, where if I just said that the average house prices in Australia was $800,000, for Sydney it's 1.3. So 1.3 million, right? So it's really, really unaffordable. So what happens is Queensland, which is the north state of Australia, like a northeast state of Australia, up from New South Wales, where Sydney is, has been seeing a massive growth in their migration from Melbourne and Sydney, because it was way more affordable. So people who were finding these two big cities super unaffordable were going a little bit up in the country to those more affordable places, right? And I've seen a lot of people that I know that when they're starting their families, they just don't want to live in a super extremely unaffordable apartment in the middle of the city, and they're happy to move up north to a place where for the same money they can have an amazing house next to the beach. Okay, so ratio for affordability is really important, and we're looking for something in the 5 and below. Then we have interest rates. So the long-term interest rate average is 5%, and interest rates will be dependent on inflation and employment. So whenever you have a country that doesn't have a stable how do we call it? So developed markets will have a constant inflation of between 1.5–2% per annum, and that's a healthy inflation. And whenever inflations are higher than that, most likely unemployment will probably go hand in hand and will be higher, and interest rates will also be way higher. Okay, so you're trying to look for markets where the interest rates are pretty stable and on that 5% and surrounding areas. Then you're gonna be looking at demand. Of course, you don't want, demand is one of the key things. If you're looking at places where you know demand is going down, I would suggest not to invest there. Basically, you want to make sure that if you're doing this as an income, then you want to have people who actually want to be renting and there's demand. If you want to be doing this as a flip, then you actually want to make sure that there's people, whether it's first home buyers or other investors, interested in buying those houses, right? Otherwise, there's no sense in getting into this if you won't be able to rent it or sell it. So many countries are now going through housing shortages, and that plays in your favor if you're trying to invest, because it reduces the probability of your property being vacant. So for instance, the city where I invested is seeing a housing shortage, and all 3 houses got rented out at a higher rent that I had forecasted, and within 1 week, right? And that's a really, really speedy way to be renting out. And when we're doing calculations, we do need to bear in mind that if there's a housing shortage, then great, you don't need to assume that your house will be vacant for a long while. But if you're looking at markets that demand is going down, then you will need to contemplate within your maths a vacancy rate, okay? Then also you want to be checking what local councils are encouraging, and if there are any like high immigration trends. So let's say, again, for Australia and New Zealand, which are countries that are receiving a massive amount of migration, then yes, what's happening is there's way more people coming into the country and the market than the amount of houses being produced. Now, Australia actually has the issue where property prices are going down because with this massive migration and massive development, they've overdeveloped with apartment units, not houses. So there was an oversupply. I saw once a year ago this graph where they were showing the number of cranes for construction, and the ones in Sydney were surpassing the biggest cities in the world, and that meant an oversupply of apartment units, okay? But migration usually is a really strong indication of demand. And finally, you have employment and economy, and here it's about checking what is the government announcing as massive developments. It could be new universities, new hospitals, new airports, new roads. You could have new bus lines, schools, whatever it is, shopping centers. All of those are indications that the market is going to be seeing growth, and it's a good indication that probably you want to be there, okay? So when we go into the area research, you'll see me talking a lot about which countries I suggest, and usually I stick to UK, US, and New Zealand. And the reason for this is because in those countries, demand is going up, and you are talking about developed countries which have certain currency stability, but also you can see some great tax benefits. You have positive cash flows in all of these markets, and you can use leverage mostly. And when you talk about laws, you want laws that are pro-landlord instead of being pro-tenant, okay? So that's why I stick to those three countries. Now, I'm gonna be showing an exercise, and I've just circled New Zealand there because I'm gonna be showing how we'll do this exercise for New Zealand, but you'll see this can be copied for any country in the world. So now that we've defined that we're gonna be focusing, let's say, on New Zealand for this exercise, the things, once you define the country, you want to be choosing cities and suburbs. So you want to be choosing cities that have more than 30,000 people. And the reason for that is that you want to make sure you have a big enough source of demand and like people living there and jobs. But also when you're going and asking for a loan, banks will be more keen on lending you money if the city has a certain number of people. If it's in the middle of nowhere in the countryside, the banks might refuse to lend you money. So you will start hearing me talk about tier 1, 2, and 3, or tier A, B, and C, whatever you want it, cities and suburbs. So tier A or tier 1 cities would be New York, Sydney, London, which are very, very unaffordable, and this strategy won't work in those unaffordable markets. Now, usually it will be the best to go for tier 3 cities, which are cities that have more than 30,000 people, but in the like high affordability part, so on the R that is 5 or below. And when you go and look at suburbs within each of these cities, usually tier 1 suburbs are mostly owner occupied. And when we learn to calculate yields, you see that yields are not great. We will be asking for the yield to be 8 and above, and the maximum yield that you will be getting out of these tier 1 suburbs is around 6%. Then tier 2 suburbs will be 50% owner occupied and 50% through renters. And then you can start finding some yields of 8% maximum. And then when you go to tier 3 suburbs, which probably are the suburbs that you and I wouldn't want to be living at, but it's great for an investment, it's not where you're going to be living, then that is where they're mostly renter occupied and your yields will be really, really high, okay? So I'm going to go on and show you guys how I would start every single time that I want to start my area search. Now that I've defined New Zealand as my country, this is how I'm going to go about it. So I'm going to stop sharing this screen, 1 second, and share. Okay, can you see my screen that I'm showing the website qb.co.nz?
Yes.
Cool. So how I go about it is you open Google and you start Googling words like average price trends or stuff like that. And you will see that there's a few free sites and you have access to free information, but also some sites that are really good and you will have to pay a membership for. I haven't started paying any memberships yet myself, but I wouldn't, as I start getting better and I start going into new cities that I don't know as much about, I would start paying. So for instance, typically big companies that offer these types of informations are CoreLogic. CoreLogic is a really big one. So you just start like, I'm gonna open here a tab and say USA property price trend. And usually I don't wanna go necessarily for any ads, but I start seeing which ones are the ones that rank higher. And here you can see global property guide could be one, trading economics. So you will have a few that you'll have to start out. Zillow, I've heard many times as a great one. So Zillow is not in New Zealand, but definitely I would consider looking at these. So Emma, if after we do this exercise, we want to run it as well for the US, we can start looking, for instance, at this page, okay?
Okay, yeah, I confirmed. Silo, I've used it to find the house that I rent right now. So it's,
Silo?
yeah.
Cool, cool. That's awesome. And I've heard it in quite a few forums. So this particular one, now that I know how I get here because I use it, I open this web page almost every other day. Basically, I go to property trends and residential house values, right? And it takes me to this screen here. And one of the things that I want to do is you can actually sort this out if you click on the arrows, and you can see that some of the districts are seeing 27% growth of the average house prices June 2019 versus June 2018, and that's massive growth. Okay, so what I'm going to do is you can click download here, and I've already downloaded it myself, so this is how it actually downloads. Can you see my screen, or do I have to stop sharing and share another one? Sorry, let me share this one. Okay, so this is how it downloads. Are you following me till now?
Yep. Yes. Yes.
Awesome. So what I'm going to do is the following. First, I'm going to give it some format. And what I'm going to be doing is I'm going to first be ordering this according to change in value. Okay. And after I arrange this in change in value, I'm going to be applying a few more columns here where I want to be doing some filters. So I'm going to be focusing number one on highest growth districts. And then number two, I'm going to go for the most affordable cities. So basically what I'm going to be asking here is that if the average price is below 300K, and then I'm going to do the same for if the average price is below 400K, okay? Let me just, so, sorry, I didn't intend to put, okay, I intended to put a sign of dollars, okay? And then I'm going to have population because we said we wanted cities with more than 30,000 people. So let's start with the whole ordering here. I'm going to first, I'm going to move this screen down. So what I'm going to be doing first is I'm going to apply filters, and I'm also going to sort. Yeah, sorry, I have to select everything. Okay, so once I've selected everything, I'm gonna put here sort, custom sort, and what I'm gonna be sorting by is the change in value, okay? And what I want it to be is from largest to smallest. There we go. So see how now it starts with those markets that are seeing the highest change in value? And what I'm going to be doing, because this market is seeing a lot of districts with high growth, I'm going to be going for those that are seeing more than double digit. Okay, so I'm going to paint in blue those that are double digit so that I will only focus on them. And what I'm going to do next is I'm going to put a formula in here, which will tell me whether the average value in June is below $300,000 and the same if it's below $400,000. So I'm going to put equals if this value here for June 2019 is lower than 300, 1, 2, 3, then I want it to say yes. Otherwise, I want it to say no. Okay? And I'm going to put the exact same formula here, but with $400,000. Okay, so if, again, this value is lower than 400, 1, 2, 3, comma, yes, comma, no. Okay, and then what I'm going to be doing is I'm going to be taking this formula down, and I'm only interested in those that are double digits, so I'm going to be doing it here. Now, population-wise, the only or the easiest way that I've found is just to Google it, right? So I don't want to start Googling like if you notice here, we have tons, like we have, let's count 29 districts in double-digit growth, and I don't really want to Google 29 districts. So what I'm going to be doing first is I'm going to be applying this filter with yes. So basically I'm going to be focusing first on those districts that are seeing double-digit growth and have an average price in June 2019 below $300,000, okay? Which means that now I've reduced my options to just 8 districts from 29. And then I go and Google those ones, okay? And then we can do the same. I can eliminate this filter, okay? So clear all filters, and if I want to go for more, then I can go and do the ones where the average, you can now have, instead of 8, you have 17, where the average value of the properties is below $400,000. So I've already done this. I'm not going to Google it right now, and I'm going to copy paste my populations that I've already pre-Googled. Let me just clear all filters, data, clear all filters, and I'm going to copy paste from another file. So I'm going to here, Control C. Okay. So basically you can see that the ones that don't have a population is because they have a no for both $300,000 and $400,000. So basically I'm going to now filter the $400,000 one. And you can see that actually populations that are 30 or above, I'm going to just start highlighting them. Let's put an orange so they're easily seen. One comment is that Southland appears as a district, but actually Southland is a region, where Invercargill and Southland, which appears here, is part of it. So Southland I'm gonna like keep out of here. But Gisborne and Wanganui and Invercargill are the ones that are those 4. So you can see you have Horowhenua, Gisborne, Wanganui, and Invercargill as the 4 that fit the criteria of being below $400,000 and have more than 30,000 people. So when you can see here, they're all seeing massive growth, and you can start seeing why I started investing in Wanganui, because if you look at the average prices, Wanganui is in that lower end, so the average prices is 290K versus Invercargill being 300, Gisborne 352, and Horowhenua 377. So that's the whole reason why I started in Wanganui, okay? Now, to be honest, I'm gonna say that the 30,000 population rule is not a strict rule, and you could find good demand and loans from banks in cities that have less than 30,000 people, right? So if you are noticing that the tricky part about these ones is that they're still above your actual price or amount of money that you have available, you could still go. For instance, I'm gonna share one that I was checking out the other day. So I was checking out these 2, okay, Tararua and South Waikato district, because they're both in 245 and 257, which is a really nice average price point, way below these ones. And they've been seeing massive growth, more than 20% annual growth, and still they are cities, as in they have more than 17,000 people, okay? If you still get your mortgage broker to get you a loan for these cities and you believe there's a strong demand, then try to make it work. Don't just take my word for like, oh, it needs to be about 30,000 people, because I might be trying things where I'm taking a risk because maybe there's less people, but you still get amazing opportunities that are seeing 22% annual growth in values, which is amazing, guys. Like, seeing that a property is growing at a 22% is absolutely amazing. Okay? Any questions about how I've done this exercise?
No, not particularly.
Okay, so what I'm going to be doing, guys, is I'm going to be sharing, after we're done with this session, a link to the exercises. And in the exercise that I'm going to share, I'm going to put the step-by-step of what I did, so you can follow it with the formulas. You can copy-paste them, okay? Cool.
Perfect.
Okay, so I'm going to stop sharing here and I'm going to go back to my presentation. Share. Okay, so we've just understood how to start looking at any market, and here you can see how I've highlighted those cities that fit the initial criteria and where they're at in New Zealand in particular. So I'm actually keen. I've invested already here. I'm checking at other areas, and I would be happy to check in Invercargill. Invercargill is in the very south of the South Island. And the reason why I'm interested in investing in the South Island is because New Zealand does have earthquakes. So I want to diversify my risk and not have all of my properties in the same island, really. So guys, I'm going to recap. Basically, during today's session, we talked about strategy, and we now have a view on what we want our initial strategy to be, whether it's for income or capital growth. And we now know how to conduct an area research, okay? Next couple of sessions, we'll be talking about fully analyzing the deals, making sure that it aligns with our strategy, raising funds, and executing the deal. So we have covered today mortgages, the rule of 72, investment strategies, and area research, okay? Any questions that you might have?
No, I'm very curious to see that step-by-step exercise.
I will send the step-by-step. And again, guys, I know when I show it, it's going a little bit fast, but you will have the link to this video if you want to replay it. But basically what I've done is I first ordered all of the information from highest growth to lowest growth. And just for ease of visibility, I highlighted the cells with double growth in this case, but that was my own choosing. What I've then done, I've put two columns where I filtered properties below $300,000 and properties below $400,000. Those amounts, I arbitrarily chose them myself. You will start seeing that if you filter properties below $200,000 and nothing appears, then you will try with a higher amount, and you can start trying to make sure that you're going for the more affordable cities. That's the whole purpose. And after you apply some filters, so let's say we start with the lower end, we go to Google and Google the populations, and we start seeing which cities we're interested in pursuing because they're the most affordable and with good size populations. Now, again, Emma, if we're going to be doing this as a trial for the US, I believe that populations in the US have nothing to do with New Zealand. Just think New Zealand has 4 million people as population. That's a very
Wow.
country. So probably a really small town will have that amount of people for you. So we will have to change a few of our selection criteria, but
Okay.
we can go for growth and then see affordability and populations.
Perfect. I'd be very curious to see this over Boulder, which is the city where I live right now, because it's a very special case. So whatever you want, Tiffy, I'd be happy to do it.
Well, we can. I'm going to encourage you if you want to do it as homework, and we can talk it together. But I'm not going to force anyone to do any homework, guys. Start learning during these sessions, and you don't feel like this is something dreadful, okay? But if you're keen, I'm happy to review it offline with you.
Okay, perfect. Thank you, Tiffy.
Cool, guys. Well, that's
okay.
it. Thanks for joining, and see you for session number 3.
Perfect. We'll be here.
Cool. Bye-bye. Have a nice night.
You too. Bye-bye.